are literally shaping the planet.
Purpose is the only pathway to a regenerative future.
We have a choice to stay with the status quo or to change.
What is the point of trying to be just resilient when we can actually innovate?
It's a pleasure to be with all of you today. Greetings from Austin, Texas. We had a long, good rain last night for the first time in 2 or 3 weeks, and we're blessed with that. As Anastasia said, the Gathering of Angels is 24 years old. I started it in New Mexico, realizing that a lot of young companies were coming out of the national laboratory, and they didn't have the seed and early stage capital that they needed. I read about a group in California called the Band of Angels, run by a gentleman named Dr. Hans Severance, and modeled what I started in Santa Fe after what he was doing in the Silicon Valley. We started in October of '96 at the El Dorado Hotel. We started having evening meetings, and in 2000 I spread it all over the country. In 2008 through 12, we had a minor blip called a recession, and we started it again. And now we do it only on a Zoom platform. So once a month on Zoom now, we have 3 young companies that present their story with PowerPoint, followed by 2 to 5 minutes of Q&A. Basically raising angel capital. One of my recent MDs, a heart surgeon, said that raising seed and early stage capital was more difficult than heart transplant. I don't know whether that's true or not, but that was his comment. It is a process that I have been doing successfully since '96. And we've raised over 400 companies have gotten funding through the Gathering of Angels. There's not a real secret to the process. There are guidelines that I offer to my presenters to encourage them to get prepared. And if they're not prepared and ready to make a presentation that actually is convincing, cogent, and intelligently presented, I encourage them to go back to the drawing table, get their act together, get their PowerPoint together. So what I ask first of the presenters that are looking for money is that they have to have a 1 or 2 in that executive summary is the problem that they're attempting to solve, what their unique and defensible solution is, how they plan to execute that solution, and what sort of sales channels they planned. I also ask that they provide to me that I can then vet and value is 3 to 5 year projections, revenue, cost of goods, cost of operations, and net profit. And then I help them create a valuation, a company valuation using discounted cash flow. As Anastasia mentioned, I taught corporate finance for 8 years in New Mexico. I used discounted cash flow with a 40% internal rate of return. That's the return that an angel investor is looking for per year on his or her investment. And then a strong management team is critical to raising capital from an angel investor. It's nice to start off in the garage by yourself and start off as a sole proprietorship, and then eventually shift over to either a C corporation or an LLC to raise money from angel investors. Angel investors are not going to invest in a sole proprietorship. You may have the greatest and most novel and unique yogurt shop that's ever been created, but without a strong team behind you, you're not going to get angel capital. I also encourage my presenters to surround themselves with both a board of advisors and a small board of directors to whom they listen, they get advice, they get counsel, they get suggestions, and they get critique, and they get stopped. Don't go that direction. That will not net you anything. So I encourage my presenters to surround themselves with a strong board of advisors, a small board of directors, and then a realistic set of projections going forward that come from their 10 to 30 page business plan. And then I also suggest to the presenters that are looking for seed and early stage capital that when they're looking for money today, they also need to offer to the investors a clearly defined exit strategy. How does an angel investing is not like friends and family. It's not like pulling money out of your 401k or your Roth IRA. It's not like tapping Uncle George, who has finally decided after you've tapped him 2 or 3 times that he's not returning your calls anymore. An angel investor wants to get his or her money back within a reasonable time period. Most angel investors are, I would say, 40 to 75 years old. They have money in their genes. They have been successful in their business life. They've accumulated excess disposable income. Then they're planning to invest not just always in the stock market, but also in young seed and early stage companies. They're looking for, the next Zoom, the next early stage company that is ahead of its time, as Zoom has been over, they're about a 2 or 3 year old company. Their revenues since COVID, are up 50 times what they were before the disease arrived, the virus arrived in the United States. So people are using Zoom. The stock market valuation for the Zooms and, the Teslas being disruptive technologies as they are, those are the ones that have high market appeal. So what's an exit strategy for a startup company? Well, everybody dreams of going public, which rarely happens, but it is a possibility, and that the investor that invests at this early stage can get his or her money back through the investment banker and the IPO that's done through that method. The most likely of which exit strategy is that they will be acquired by big fish in their specific industry. The least likely and the least appealing to an investor is that he'll put his or her money in and the company will go bankrupt. That is an exit strategy, and you write it off on your tax returns as a complete loss. There are other stages like walking wounded. The company is still alive, but it's not making any forward progress. So the most ideal exit strategy at this time at the seed and early stage is an acquisition by a big fish, an IBM or, an Indeed if it's in the recruitment business. Finding a company that's publicly traded that needs what you have as an entrepreneur and that will pay you dearly for the opportunity to acquire you or have you work under their umbrella. It often starts as a strategic investment. They may take a 5 to 10 to 20% interest in your company, and then eventually will acquire all of the balance of the stock, and you'll get to go to Maui and live on the beach the rest of your life. So an exit strategy is something that I encourage my entrepreneurs to have going into an investment. What is the ideal amount of money that you should try to raise during the seed and early stage? I would say between $250,000 and $1 million is probably the stage after friends and family, after you put all your precious savings into the company and taken no salary for the last 1 or 2 or 3 years. You've developed a novel approach to a problem that's large, and that you have the solution, and that you also have the unfair competitive advantage, potentially, that you have gotten patent protection or patent pending protection for anybody that might come and duplicate exactly what you're doing, and that you basically have a strong team around you of both board of advisors, board of directors. You've accumulated also some strong management team people that have strengths that you don't have. And that so, it doesn't do the company or you any good to invite on the team people that are just like you, that have the same skill set. So somebody that's a wonderful, strong, charismatic marketing person, but weak on the finance side, needs to have supplement that weakness by having a strong finance person, having somebody that's been to the rodeo before and that has really industry knowledge, both on the management team and on the board of advisors, and then have a clearly defined exit strategy for the investor. In a period of 2 to 4 years, maybe 5 years at the most. You say, well, I don't want to cash out. I'd like to keep the stock. I'd like to keep the company private as it is today. But that's not the interest of an angel investor. They would like to have their money back. They're not going to put all of their savings and all of their dry powder into your company. It is smart. It is safe to basically spread that money around through diversification. So the angel process is not an easy one. It is challenging. It is tough. But there are guidelines that I provide to my potential presenters to help them basically raise the capital that they need to get started, to launch their rocket ship, and to create value for the angel investors that are coming along for the ride. A lot of them will have interest in being on the board of advisors of a young company. So it's not just an equity investment that they're interested in making. They basically would like to also, help and coach and counsel the entrepreneurs. They've been to the rodeo several times. Most of the entrepreneurs have been once or twice, hopefully, and having a strong board of advisors is really very helpful. I'm sorry, but my voice is going out. I was on an airplane most of yesterday. So I'm certainly open to questions if there are some. The angel process is something that I've enjoyed being a part of. My teaching in New Mexico at the graduate level helped get me ready and prepared for this new adventure in my life. I've enjoyed being a part of it now for the last 24 years. I was an entrepreneur from early days. I started my first business when I was 7 years old, importing fireworks into Georgia, and did that for 2 years until a lightning strike hit all my fireworks supply in the backyard and started a fire that almost burned down E River School there in Atlanta. But I've enjoyed the entrepreneurial process. I love the coaching component for it, and I believe that the gathering of angels is a worthy and strong, noble effort, and I hope to continue it for a long time. Thank you very much for listening to my story. I'll certainly entertain any questions that you might have, and I look forward to answering them to the best of my ability. Thank you.
All right, Tarby, so I do have a question for you. What motivates you emotionally to be an angel investor?
It's the chance to invest early in a Microsoft, an Apple, a Zoom, any of the companies that you can get into at an early stage as an angel investor is fraught with risk, fraught with the opportunity for a high return. And I think it's the opportunity to buy something early in the process at a lower price per share, lower valuation than you'd have to if you were to invest it in the NASDAQ or the stock exchange, the New York Stock Exchange. So, everything in life is timing. And if you can get in early, that's the real incentive for an angel investor. And corporations, young corporations, startup businesses always need capital. I did an article, an interview several years ago for the AJC there in Atlanta. And the title of the article is Entrepreneurs Always Need Money. If they're going to get their business started, they're going to need capital when the bank account is low and the friends and family and the Uncle George stop answering the call. It's time for an angel investor. The startup companies with zero revenue or 2 or 3 paying customers are not prospects for venture capital yet. They may be in the future. And so an angel investor fills that gap. I call it the capital gap. Before an investment banker or a venture capitalist would step in and play a major role in the success of the business. And after friends and family and Uncle George, that's where angel investors are best served, and they basically look for a high return. Usually 35 to 40% internal rate of return on their money per year is the normal angel return on capital, and they're taking high risk and for which they deserve a high return.
Awesome. So I got a question from Miguel. What percentage of your investments are in technology?
I would say that today the gathering of angels probably 85 to 90%. Mm-hmm. The other 10% is in real estate or a service sort of businesses. The technology sector is hot. I would say also the medical device sector is also hot. So I would say that the technology and medical device are probably the 2 hottest ones that we've found capital for recently. The checks that are being written by angel investors today are different than they were, 5, 6, 7 years ago when people were writing $200,000, $300,000, $500,000 checks. Most of the checks today are $25,000, $50,000, $100,000. I had a $200,000 check written about 3 months ago to an automobile technology company here in Austin. So the checks are smaller. The level of due diligence that angel investors are performing before they pull the trigger and write a check is a little longer than it was before. It's not the mad frenzy and flourish to go after and just wave checks in the air. That doesn't really happen anymore. Maybe that's a good thing. I know the entrepreneurs would like to have checks written. I did one meeting in Santa Fe 15 years ago. We raised $1,600,000 on one night with about 21 different checks. Everybody brought their checkbook at that time, and they saw Larry Tilley's Vet Med online company present, and he got $1,600,000 in checks on that particular night. The next day he said, "Tarby, I really would like to have it all from one source. I found a venture capital firm in Silicon Valley They wrote the $1.6 million, and I returned the 21 checks to my angel group there in Santa Fe. But those were different times. People are a lot more skeptical, a lot more cautious, and a lot more introspective, and due diligence is a little longer process. Usually it takes 1 to 30 days after a gathering of angels meeting for an angel investor to pull the trigger. And I think that's a good thing. Due diligence is critical. Checking out the entrepreneur, checking out the customers that they have, the paying customers, and also confirming the strong business model and clarifying the exit strategy. So due diligence is critical, and I really encourage all of my angel investors to not just pull out a checkbook out of emotion and write a check.
So speaking to that, do you require paying customers prior to making an investment?
It helps. And unless, having paying customers, somebody that has validated the customer acquisition cost is a good thing. I have done fundings before with just, a business plan and reasonable projections, and maybe a strong management team without paying customers. But the raising of capital from angel investors comes more regularly and recurringly when a company has customers, who like the widget, they're buying the widget at a price, and you have some better idea of what it costs to produce the widget. And having customers is an important thing. Not always necessary, but it certainly helps in accelerating the process of funding.
All right. And then the final question, I want to get this one in from Scott Patterson. How do you create deal flow and find the right companies for investment?
I have a pretty broad network, fortunately, across the country. I lived in Atlanta for 45 years, and a lot of CPAs, lawyers, and financial folk there in the Atlanta area. I had meetings in Hilton Head and Washington, D.C., and Jacksonville and Charlotte. So I've had meetings all over the country, 3 cities in Texas, Scottsdale, 3 cities in California. So I've built up over the years, 24 years of doing this, a network of angel investors who always have, a child that they put money into and that they would like to get some of it back. So, they're one source. Certainly referrals from CPAs and lawyers and financial advisors is another source. More recently, over the last 4 or 5 years, search engine optimization, SEO, has driven companies to me. I spend, 10 to 15 hours preparing and training and coaching the entrepreneur once they say they're coming, they're interested in presenting. I had 3 presenters last Thursday for my gathering of angels. I spent probably 40 hours aggregated on the 3 presenters, getting them ready and prepared to present. On the day of the event, we have practice sessions, mandatory, with about 4 or 5 local coaches that polish the presentation, remove any jokes that don't work, any things that don't make any sense in the presentation, and compressing it into a very tight, succinct 15-minute presentation with 5 minutes, the first 5 minutes on the product or the service, why it's different, why it's novel, why it's unique, the channel, the sales channels, the competitive advantage, 5 minutes on the management team and advisors, and then 5 minutes on the financial projections, the margins, and the exit strategy, and then a strong, what I call a Baptist close.
All right, Tarby, thank you so much for taking some time out of your day to share your wisdom with us as a seasoned angel investor. And then we are going to move, we have a few minutes between speakers. So everybody, like I mentioned before, we are having a conversation, continuing everything in Slack. Feel free to move over there. It is the Shadow Summit 2020 channel. You all should have access to it, and there's a great conversation going. So feel free to hop in, have a conversation, hop back. We have Anita up next. So I'm going to give her a few minutes. Everybody, if you need to hop up, stretch out for a little bit, you have 5 minutes, and we'll be back with Anita. Thank you.
Thank you very much.